Hi everyone, welcome to the live webinar with Admiral Markets. Today's focus is on trend trading. We're going to take a look at how to define the trend. We're going to see how to find the retracements and trade those dips and rallies, depending of course on which direction we're looking at. First though, be aware that this live webinar is shown to a global audience but may not be suitable for everyone. Please visit admiralmarketsglobal.com, select your country of residence, and contact the appropriate entity to find out if it is suitable for you. Also, please note that trading for exchange and global financial markets is considered high risk. Please seek the advice of an independent financial advisor for more information on that. This webinar is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. All right, thanks for your attention on that. Nenad and myself, Chris, we're going to share our vision, share our tips, and look at concrete examples how to trade the trends, also explain why it's beneficial. Before we do that though, as you probably know, there's a UK elections going on and this is impacting the market. So take a look at this event page. It brings you stats, graphs, webinars, articles. You can find out a lot of information there. The link is above, or you can go just to admiralmarkets.com, click on the banner at the top, and it will bring you to that page. If you're not aware, tomorrow at 3 p.m. we have a special webinar dedicated to the results of that, and we're going to take a look at some of the politics behind it, but also, of course, taking a look at the financial markets, whether what is price saying, how does the market structure look like, and more in tomorrow's webinar. Alrighty, so some key advantages of trading with the trend. Well, basically, trend trading, it's something that, generally speaking, is a bit, let's say, more rare than ranges. Typically, trends are not so common in comparison to ranges. Prices often going in a range sideways, and I would say maybe 1 out of 3 is trending, 2 out of 3 is going sideways, just a rough estimate, right? But of course, if we monitor multiple charts, if we monitor multiple time frames, we're going to sooner or later find something that's interesting for a trend. So that's the advantage of kind of looking at multiple dimensions in a way, in the sense of, as I said, time frames and currencies or instruments in general, because then you will be able to trade with the trend more often. Whereas if you only focus on, let's say, euro dollar and you only look at the 4-hour chart, then there are going to be many times it's not trending and sometimes, yes, trending. So you're going to have to either trade the range or wait a long time. So that's one advantage of just like scouting and scanning for a trend. Now, why would you do that? So you can trade with the flow, because the advantage of the trend is that basically prices a continuous push in one direction, or not maybe continuous, but a sturdy push, not a sturdy, but let's say a ongoing with retracements, but still a continuous kind of push forward. So what I mean with that is that you'll have price, of course, not move in one rocket to the upside, but there will be at times where price is moving more forward, then maybe making a retracement, but then moving forward again, making a retracement. But all in all, there is that pattern of an upside or downside. All right, so the advantage of that is that you're trading with the flow. What I mean with that is that if you want to swim on the river, you're going to be a lot easier in the position to trade with that current than rather than trading against the current. So swimming, sorry. So trading is very similar to that. All right, so every time you think about which direction you want to trade, the swimming example is a very easy one to remember and is very intuitive why it's so important. Just picture yourself swimming with the current or against it. And it's a lot tougher against it, as we know. Other advantages, better reward to risk, or basically the R to R ratio. So we can get more mileage because price is continuing for a lengthy period of time into that one direction. We can aim for higher targets, therefore getting more out of our trades. We can be a bit more patient with the trade because although price might go sideways for a while, on average, kind of the price goes with us, with our position, so we can be more patient. price kind of drifts our way. Therefore, the odds of success are also higher, and it's going to be easier to find those trading opportunities. There'll be more plentiful trading opportunities as well, specifically compared to reversal trading. So some basics about the trend. A range is price movement that is going sideways. That's the left example. This is not a trend. Sometimes I have heard traders say or talk about sideways trend, or I don't know, like a flat trend or something like that. But from my perspective, that doesn't exist. If price is going sideways, this is a range, sideways movement, consolidation zone. Those are all fine. A trend is something that has an angle to it, and not only any angle. There has to be some kind of significant angle to it, and you're talking, obviously, if there is a 1 degree upside, like very slight upside like that, that's not a trend. You have to have at least like, an angle like this, where you have a line that, if you have a trend line that is moving away from the bottom with at least, I don't know, a 20-degree angle or something like that, at the minimum would be good for a trend. Preferably even more, but I would say 20 is the minimum. 45-degree angle is a pretty steep trend, but those occur definitely as well. So this is more of a steeper trend channel. So the slope is, of course, a very important aspect of it, as I just mentioned, up or down. Now, simply put, we could define the trend as a series of higher highs and higher lows, or lower lows and lower highs for a downtrend. So with higher highs and higher lows, as you see here, this is an uptrend. You would basically compare this bottom to these bottoms right here and conclude that there are higher lows. You would also compare these tops with each other and conclude that there are higher highs. So that's it. That's an uptrend, a series, a pattern of those. And what we're looking for is typically 3 higher lows in a row, and that's a confirmation of an uptrend, or 3 lower highs for a downtrend. Now, there's even a simpler way, in fact, and that's just to compare the charts, the chart that you're looking at, compare the right to the left, and if price on the right is higher than the left, we're in an uptrend, or if it's lower, we're in a downtrend. So, here price pretty much higher than where it started on the chart, right? So it's an uptrend. So that's the very basic way of looking at it. And but there are traders out there with a lot of experience that don't use any indicators, just purely instinctively, intuitively look at the chart and just spot the trend like that. But if you're starting out, or you've been trading maybe just only, let's say, a few months or even a few years, it's good to have some indicators that help you digest this information in a way. So one of the things, if you want to just purely look at the charts without any tools, you can compare right to left, and you can use the concept of higher highs and higher lows, and lower lows and lower highs. We'll be diving into some tools in just a second. First, though, before doing that, keep in mind that it's good to choose 1 or 2 time frames, I think, that you focus on and to try to find a trend. Because if you're trying to find a trend on a monthly chart, and then you zoom in to try to find a trend on the 5-minute chart, I think nothing is impossible, but let's say that it's maybe a bit difficult for someone who is starting to combine all of that to make a coherent plan. So at the start, at least, I would choose like 1 or 2 time frames that those are the time frames you use for trends. So that could be scanning many pairs, but focusing on, let's say, 1 and 4 hour charts for trends. In any case, whatever time frames you choose, it's good to stick to those because those kind of have their own movement as well. But make sure that it is always, in my opinion at least, when you use 3 time frames, and I think multiple time frame analysis is best with 3. Make sure that the trend, we think that the trend chart is the best if it's the middle. The support or resistance chart, when you're looking at the higher time frames, should be the highest time frame. And the entry chart should be either the same as trend or better, even one below the trend, I think. So daily chart, for instance, could be support or resistance. 4-hour chart could be the trend, and the hourly chart could be the entry or and trigger. Right? Weekly chart could be the support or resistance. Daily chart could be the trend, and the 4-hour chart could be the entry. Daily chart could be support or resistance. 1-hour chart could be trend. 5-minute chart could be entry. So those are some examples. And just keep in mind one more thing regarding the trend is that just because it's trending doesn't mean the price has to continue with that trend right here, right now. At any time, there must be a continuation. No, that's not how trends work, and we have to keep that in mind. That's why we have to kind of emphasize the fact that yes, trends can be found on all time frames, but it's good to focus on the ones that the time frames that you prefer and that you let's say focus on. It's also good to keep an eye on the fact that the trend is not everything. You have support and resistance levels to keep an eye on, patterns to focus on and to spot, and also above all, our goal as trend traders primarily is to be realistic trend traders. So we've all had, or not all of us, but many of us have heard at least stories about beginners being very lucky. I don't know why this is very often the case. And I think that the reason is because they just, by coincidence, catch a trend. They don't even realize the trend is, on the chart. They don't even see the trend. They don't even see it as, it's not visible to them. But they catch this kind of like push in one direction. They think that nothing can go wrong. Of course, then the trend is over, the reverse happens, or we get a retracement, or we get some kind of consolidation zone, and boom, the equity curve just drops like a stone because they keep doing the same, anticipating the same, but the market structure has changed in the meantime. They don't recognize that, and that's it. So you got to find that sweet zone where we're not that naive about the trend, right? Because we recognize it and understand what it is, but we're not scared of it either, because the thing is that eventually, if you put more effort into it and you get better at it and you know more about it, it's kind of a flip thing. Almost our psychology flips, and rather than looking for trend opportunities, we start to imagine reversals everywhere. Problem is that reversals, real big reversals, are not something that occur very often. They occur even less than trending environments too. And I don't know, it's just my opinion, but it seems like kind of our minds try to play games with us and say, oh, we see trend potential reversals at every corner. So that's why I'm going to be realistic. Like, we want to, trend trading is great, but it doesn't occur everywhere. Reversals are even rarer. We just want to be waiting for the right moments to continue with that trend trade, because there could be a significant time where price pauses before the trend continues, and often you see then traders enter the trade into the direction of the trend. They wait, they get out of the trend trade because it just takes so long, and boom, then it goes their way. What happened was they entered at the end of the impulse, they waited through the consolidation, at the very end they exited just before the price continues. How many of us have had that? That's also partly why did we run out of patience, partly because if our entry would have been more precise and would have been at the end of the consolidation, we would have had to wait less long and the trade would have gone in our way quicker. So by knowing and understanding that the trend has different phases, so we got to not only trade in the direction of the trend, but also find the right timing and the right spot will help us greatly with trend trading. The tools I personally use, I use weekly pivot points to understand if price is below or above the weekly pivot. So that's one thing. I use Admiral Markets pivot points for that, part of the MetaTrader 4 Supreme Edition. And that's part of many other indicators and tools and options that you can use for managing trades, for understanding and analyzing charts, and managing trades setups as well. So a lot of good things there, and you can find that on admiralmarkets.com. So that's one. The other I use is moving averages, as I'm discussing here. So I use primarily two moving averages. And I do use a third one, but it's not really for trend purposes. It's for entry purposes. But the two I use for trend are 144 EMA close and the 21 EMA close. 144 obviously for long term, 21 for short term. And basically they measure and give understanding of what's going on. So as you can see in these two examples, when price is above the 144 and the 21 is above the 144, you get trend alignment to the upside. If you have 21 EMA below the 144 and price below both, you have alignment to the downside. So these are very trending phases. So when that happens, I know that there's a good chance of a good momentum appearing on the chart. So this is by far my favorite combination, but it's not the only combination. I think that moving averages are pretty flexible. I think that all of them are more or less of equal value. Why I have these is just purely based on Fibonacci sequence levels. So it's more of a habit I got used to, and I'm comfortable with these. But if you use 20 and 150, will it matter much? I don't think so. Or if you use 50 and 150, probably not so much, right? You get the point. So these are just my favorites, but I think that there's not much of a difference. EMA, according to the studies I've seen on moving averages, EMA do beat SMA on earning potential in the statistics, the studies that I've seen about this. But who knows, that was a while back, maybe 2-3 years in the meantime. So other things to consider with moving averages is the angle, the space between the moving averages. All right, so when the 21 is moving away from the 144, more space is available here, as you can see. Plus, of course, the angle is in both cases bearish here, in both cases bullish here, plus some widening of the angle. So all confirmation of more trend to the upside and to the downside here. So ultimately, angle, space, and of course, as I already explained, the relationship of the moving averages and price to each other. So this is a special moving average indicator, by the way, because the color of the moving average changes accordingly, if it's bearish or bullish. So if you're interested in this indicator, I got my email address here in the right lower corner. If you are watching the recording, you could just pause it, write it down, send me an email. I'll send you this MA indicator for free, no problems. If you're watching live now, I guess I will write it down for you just very quickly in the chat here. So that's cool. What I like about this indicator is just the fact that I don't have to squint my eyes to see what it's saying. I just look at the color. I immediately know intuitively, just very quickly, so that saves me processing power, my brain to be specifically, so that I can focus on other things. I like to simplify my charts, simplify my analysis. These moving averages do that for me at least. Other things you can use for trend trading: fractals, trend channels, Ichimoku, pivot points. Now I don't use Ichimoku. I do think it's has merit, a lot of merit to it, I prefer moving averages with pivot points, fractals, and trend channels. And there are probably many more things to consider for the trend, but I thought these were the main ones. For myself, moving average, trend channels, fractals, and pivot points. So what I would be looking for is the channels are more of a supportive, if I see them, I draw them kind of thing. If they're not there, they're not there. Sometimes a single trend line is fine too. It's something that if my eye sees it, and I'll draw it. And of course, as you can imagine, I've looked at many charts over those years, so that kind of goes naturally. And if you're new to channels, it's very good practice just to go back in time, draw those channels, and learn by actually drawing them and practicing with them, and then you'll get kind of build that pattern recognition. You know, that's the best way to build that experience. Live, real time, but also going in the past. Fractals, as you see in the bottom example, are supportive resistance levels, but they help me also with the sequence of higher highs and higher lows. So here too, sometimes it's very obvious what the higher highs and lower lows are, sometimes less obvious. So I like those fractals just to, again, simplify it for myself. Don't have to squint my eyes to see, oh, is that a higher high? No, it seems like it's even. So I can just quickly see that, without troubling my eyes too much, and I hope that will help me in the long run with my eyesight. So, and then the last one, no, that's it. Yeah, good. So, how about retracements? Because trend is one thing, but we, as I already said, we want to be realistic trend traders. So, measuring the retracements, very important. Now, one of the ways to do, in this example, you see Admiral Keltner band, which is part of the MetaTrader 4 Supreme Edition as well. I like the Keltner band because it indicates very well where price is reaching support in the uptrend or resistance in the downtrend. So here you can see the Keltner breaking above the, price breaking above the Keltner, and eventually it's going to go back to the bottom, as you can see here and here. So those are opportunities to join the trend. The 21 EMA close would be riding somewhere probably around here. So that would give you a bit more frequent opportunities to join a potential trend. Just, of course, be careful that at some points you'll get a larger correction, like here. And that's when the Keltner will become valuable. The third thing for measuring retracements is using a trend channel, like this or like this. Oh. And waiting for price to get to the bottom in an uptrend or the top in a downtrend. Retracements also occur when prices, it's testing multiple fractals. So if you have a fractal here and a fractal here and a fractal here, that's becoming a pretty strong support level. Another thing to consider for retracements is the oscillator. So if price is getting back to the middle, I use the awesome oscillator for that. Then that means that the retracement is completed as well, most likely, or soon to be completed. And candlestick patterns, of course, also indicating the potential end of a completion. That's a bit difficult to see with this small chart, but you get my point probably. Candlestick pattern is also very important for knowing when the retracements could be finished. So these are some tips. The end of the trend, divergence. So for instance, depending on the time frame, multiple divergence sometimes needed, or if there's divergence on multiple time frames, the more divergence, of course, the stronger this pattern will play out, and the stronger the impact it will have. Because if there's only one divergence, well, it's a weekly chart, it's still important, but the thing is, when does it play out? That's always the tricky part of reversals, is that traders attempt 5 times to trade the reversal. 5 times it doesn't work out, and maybe the 7th or 8th time it finally does occur, and you get the bigger reversal. So all that effort is invested into finding one setup, but it's so difficult to find the right moment that price is going to reverse. There might be a lot of signals hanging in the air, like divergence, but price can still continue with the trend for a lengthy period of time before the divergence really kicks in, really starts this whole process of the reversal. And therefore, I'm pretty critical of reversals. I don't avoid them entirely, but I do want to see multiple things add up and multiple confluence. I want to see a decent divergence, preferably multiple divergence on time frames or same time frame. I want to see strong support or resistance levels so that there's a reason for price to stop there. And the market structure in general, just analyzing high time frames and understanding why the trend might end there. And then candlestick patterns to top it off and to kind of confirm that. And also chart patterns, head and shoulders, rising wedges, double tops, and stuff like that also confirm. So if you add all these things up, then it will be easier to spot. Trading it is, again, a different art. It is possible, but in my opinion, needs more experience to master and takes more time. And but in any case, it's good to be aware of this, because if you are trading with the trend, then it's also good to know when the trend is ending, because that's the moment to exit as well. So the trend is your friend until it bends. Very famous, of course. It's very true. And for us trend traders, it's good for exits. And maybe one day, might be interesting to think about reversal trades. But yeah, it's not the easiest thing to do successfully. All right, got a couple of minutes left, but I think that those were the main points. So from my side, I think if Nenad is here, I can already pass it on to Nenad. Let's see. Not sure he's starting a few minutes from now. If there are any questions, of course.
Hey, Chris, I'm here. I'm
Great.
closely listening to you. So
Perfect. Great, matey. If there are any questions, feel free to let me know. But otherwise, I'm going to pass it over to Nenad here. Let me see. There we go.
Thanks, Chris. And as my friend Chris said, basically, you really need to distinguish between sideways, chop, and trend. Trend always has an angle, while sideways movement is not a trend. That is very important for you to understand it, and also for traders who are watching this on YouTube, because I've seen really a lot of traders and the people who actually are educators, and they call sideways movement a trend. That's not correct. As Chris explained, sideways movement is not a trend. It's hard to make money in sideways trend. I know, because I've been there, and I will explain it also today. That is very important for all of you to know. So we might start, and as we already know, and as Chris said, trend definition is simple. Is the basic of all definition is that uptrend is a series of higher highs and higher lows, while downtrend is series of lower highs and lower lows. It's simple as that. There is no philosophy in that. Very simple. Sideways movement, it's not a trend. It's ranging market. It's a common phrase. We call it a ranging market. But sideways chop, sideways whipsaw, sideways shark tooth, whatever, it's simply non-tradable. I don't know. There are some people who are able to make money in sideways trend. I don't know how to make money in sideways trend. Simply because I cannot go for a rectangle trading, because I don't know if that rectangle will break, and I'm not into the mood to every time it reaches up or bottom of the rectangle, I need to protect my profits. I really don't know. So the biggest thing is, and it will always be like that, guys, it will always be like that. Trend is your friend. Don't listen to other people saying it's not a fact. It's good. It's the fact. And we make money in trends. And I'm not saying that you cannot make money in trend. in counter trend. You can, of course. We already did some parts with counter trend. I showed you Australian dollar yesterday in live trading, and you saw what happened after the webinar. Price reached 2 pips shy. It was 2 pips shy from pending sell, but it was a counter trend trade. Still, trend trading is the most profitable. Why? Because big money, big traders, big institutional money is making a trend. It's like a shark. I always compare it to the shark. And you're the fish who follows the shark, right? So we call the trend movement zigzag. Why zigzag? It's not like indicator zigzag, but simply indicator zigzag got its name from let's say, a trend picture. This is zigzag. This is zigzag. Trend always has an angle, and trend always has a zigzag. Okay? Remember that. Don't fall for those educators and analysts telling you that sideways trend exists. There is no sideways trend. Sideways movement it's a consolidation. It's not a trend. Trend is this. This is the trend. Up or down. That's the trend. So, an example. Flat. This is no trend. Flattish movement. Up and down. Up and down. This is where new traders lose their money. Mikhail is saying, when I hear your voice, I know I will make money. Thanks, Mikhail, but today we have an educational webinar. We don't have trading webinar. So, you see, this is no trend. This is flat. This was a beginning of a strong uptrend. And you see, this is consolidation. It's perfectly normal to have a consolidation because traders are pulling out of their positions here. Watch this, guys. This is important. This was a spike, a big spike. It doesn't matter which pair this is. This is pound dollar, I think, but it doesn't matter. This is the spike. And you see this candle here, these wicks here. And this simple wick is telling you that traders are pulling out of their long position. Each close of a long position is automatic sell into the market. So when they close their buy positions, their platforms automatically sell. And you see there was a drop. And then there was a consolidation. But this is not a trend. This is a trend. This is when trend has started. This is trust pullback, trust pullback, trust pullback, trust pullback. Uptrend, series of trust and pullbacks. And yes, it's very hard to trade only by trend lines. Now someone will ask, okay, Nenad, if it's like that, then why don't you use trend lines only? That's why, because you see, this trend line was broken. Now we have another trend line. You can put another trend line here. So trend lines are one of the tools we use for determining our entry position. Being a trader and analyst, it's not the same. I am both. Chris is also a trader and analyst. So we also trade money and we analyze market for you. And I think that's the biggest advantage, to be with us, to be here with us, because we are not just, you know, it's a not a good name, bookworms, because learn analysis and then analyze the price. It doesn't go like that. In order to fully understand the price, you need to feel everything market has to offer, both good times and bad times, right? So you need to feel how is when you lose money in order to make up for that mistake and then learn from those mistakes. So that is the biggest difference between analysts and traders. Analysts, they just analyze price, but they don't have anything to worry about money management, about possible entries. The responsibility is not the same. That is why we always give you the possibility to trade with us, live trading webinars, to learn the price in its full sense. That is what we do. That is what we are teaching you. So simply using a trend line is not enough. We need to use confluence. Confluence or POC zone, point of confluence, is where every important price aspect are making a vortex, a zone, a confluence. That is when you see a river and there is two rivers there, they have a confluence and they make up for a bigger river, or they go straight into the sea. That is the confluence. Similar is with price action. You need to use trend lines, Fibonacci ratios, historical levels of support and resistance. That is the main thing in trading. And doing the analysis is not just give me a random level, look at RSI, it's going above RSI, below RSI. That's, guys, no one is interested in that. You're interested to make money. You're interested to make profits. That is why you need to know about price as traders, not just to analyze what could happen. In trading, reaction matters more than prediction. In analysis, prediction is everything. In trading, reaction is everything. When you connect trading and analysis, you get both prediction and reaction. And that is the biggest advantage of being a trader. Muhammad is asking, how do I know where POC is or confluence? You cannot know without learning. That is why we teach you. Go to Price Action Training School, listen to our webinars, get to our live trading webinars, and read the analysis. You will always see POC on my analysis. And then you will figure it out, right? It's a bit subjective. That is why we cannot make any expert advisor that is based on my POC zones. It's impossible. That is the knowledge. That is human brain. We try to make a robot expert advisor, but we cannot do it, because it is, when I do the analysis, it is what I see. I see the POC zone. I chart it myself. I cannot let a robot do it because it might get wrong. Okay, let's move on. Angel is saying, thank you for yesterday gold advice. I made good pips. I'm very glad, Angel, really. And yes, the gold is something that I really, I haven't analyzed it that much, but I get a feel for it. And well, let's see, but I think I'll start doing it regularly. Yeah, indeed. So, okay, downtrend is when price is making a lower lows and lower highs. Price simply goes down. Thrust and pullback, but in south direction. You see? Thrust, pullback, thrust, pullback, thrust, pullback. It's very, very important to understand how trend is shaped. Without it, it's impossible to know the difference between sideways chop, trend, and the ending of trend or reversal. Yeah. So this is the trend principle. High, low, lower, high, lower, low. You see lower, high, lower, low, lower, high, lower, low. Now, this is the low of down move, because then the price obviously started to make higher lows and higher highs. This is the high, higher low. You see, when this trend line is broken, now we have an up move, up move, up move. This is correction. So always watch what price does on higher time frames, or if you're not familiar with multiple time frame concept, simply use 1 hour time frame. 1 hour time frame is the best compromise between intraday trading and let's say scalp swings, because on 1 hour time frame you can have both scalps and both positional trading, and very often you can leave the trade running for 2 days. Trend principle. This is a strong downtrend. Now we have sideways chop, weak downtrend, and very strong downtrend. So You always need to understand if there is weak downtrend or strong downtrend or uptrend. The point is, when there is sideways chop, you better stay out of your trade. Or if you're eager to make a position, define your entry point and don't go for multiple positions, because in sideways chop, multiple position trading will lead to loss of your account probably. I know a lot of traders who actually lost their money by trading range. You know what the problem is with range? You think, okay, for example, you open your position here. Price goes there, you didn't close your profits. Suddenly price goes up, you open a long position. Then price goes down, you open a short position. Price goes up, you open longs, and so on, and your account is no more. So if you're still catched in a trend or trapped, not in a trend, but in a sideways chop, leave your position. If you have a loss, accept a loss. Don't think that you will revenge it. Just accept your loss. It's normal. It's very normal. It's perfectly normal to have losses in trading. Especially if you trade on intraday time frames, or if you trade, let's say, scalps most of the price of the time. Because scalps are, they're subject, they're very prone to losing. And you see, Angel is saying, you're honest, I lost a lot when I start this way chasing price. Indeed, Angel, that is correct. Usually the people will start to lose. Chasing the market is a way to lose your account. So the main principle is trend is your friend. Trend is your friend because the trend is created by market movers, institutions, big investment houses, big investment firms, money remittance companies, general transactions between countries. But let's say that big hedge funds can also move the market. Of course, central banks. But when everyone is aligned of those big players, that is where you see a trend. And that is when you start to understand that trend will be your friend, because you will be following big fish in order to make money. Remember though that trend exists on each time frame, and those time frames can be a trap. If you're not familiar with MTF trading or multiple time frame trading, then simply stick to 1 hour time frame. That is good compromise for intraday trading. Yeah, Angel is saying he stopped his losses when he found price action trading school. Yeah, nice, very nice. So the main principle is trend is always traded as buy the dip, sell into rallies. You need to identify pullbacks on higher time frames and zoom into lower time frames, or use 1 hour time frame if you don't want to use multiple time frame analysis. I prefer 1 hour time frame, you know, where I make the analysis, and when I do live trading on Wednesdays, I really prefer 1 hour time frame. Have in mind that basket trading is buying or selling multiple currencies, but it can be dangerous because correlation is also lost for some currencies. So if you want to go with a trend and you want to trade multiple currencies, then definitely use trend following and correlation matrix. This is the example of a correlation matrix. Now I will open the chart and I will show you. Give me a few seconds. Okay, correlation matrix is here. So go to Admiral Markets, download your Supreme Edition, double click correlation matrix. Okay, then just enter Euro crosses, for example. And here you will see how correlation matrix looks. And you can see there is a big, let's say, positive correlation between various euro crosses. But also, guys, notice that also there is some negative correlation between euro crosses. So if you go with euro dollar and euro yen, it's a little bit negative. They might move in opposite direction. Euro dollar and euro Swiss move completely, almost completely in the opposite direction, while euro dollar and euro CAD goes completely the same direction. So now you might think, okay, if I go with a trend, I watch euro index, right? And if I see that euro index is good, is strong, that means that I can buy every single euro currency, right? Well, you will be wrong, because there is correlation. Buying euro dollar, buying euro CAD is okay. But if you go with buy with euro Australian dollar or buy with euro Swissy, it not might be that good. Although this is okay, but it's not very strong. Let alone euro New Zealand. They go opposite. You might say, okay, euro is a bit strong, but let's say I want to trade also euro Polish zloty, right? And what happens here? Okay, a lot of negative correlation. You might also say, okay, I will go with buying euro dollar, but I'm sure that euro New Zealand will also be a buy because euro index is strong. Euro is going up. Well, you see, it's minus 24. It will go up, but then it will start to go down. And you might feel, like you might lost your euro New Zealand trade. So always watch for correlation, because correlation is what matters in forex trading. You can use the same for dollar crosses. Just get with dollar and use dollar crosses. See how it goes. Where, of course, try to go with dollar yen and also with pairs where dollar is the quoted currency, like GBP dollar. GBP is base, dollar is quoted currency. You need to understand it. Else, well, you might go in a trend, but that trend will not be that good on different markets. That is why I suggest that you try to go with one pair and do it on one hour time frame. So the main principle, positional trading, is always buying the dips, selling on rallies. Buy when price is oversold, sell when price is overbought. This is it. POC zones. Price is oversold here, so it's better than to sell it here. But if you are not familiar with scaling in, I can say divide your risk. Use total of 2% per risk. This is 1% of risk, and if the price goes up, 1% of risk. You need to go with your basic risk management. But this is very important. You're buying in uptrend when price is oversold. You're selling in downtrend when price is overbought. Each time frame has its trend. Higher time frames are stronger. Lower time frames change the first. So this is where traders might get trapped. A lot of times, some multiple time frame traders who like to trade multiple time frame analysis, they might say, okay, I will try to trade multiple time frames, but I occasionally lose the trade because price is getting uh, reversed. Why is that? Because lower time frames will always change the first. Remember that they will always change the first. And when you get into that multiple time frame concept, it's not enough to just watch higher time frames. You need to watch lower time frames, because on lower time frames, the price will change, and then you might opt to protect your profits. That is very, very good strategy. So if you are picking back momentum from higher time frames, you get into position, ride higher time frame momentum, watch also lower time frame. When momentum changes, you need to protect your profits. Also, 1 hour, I remind you again, is the best compromise for intraday positional trading. So when price is getting up, is going up, you don't want to buy here. The only thing when we buy is when a daily high is broken and price makes a pullback and retest. That is when we can trade the first break of high, but the first break of daily high or a daily low. In positional trading, you wait for the dip. The dip means price drops. So here we would go for a buy around this level, not here. You don't buy when price is in no man's land. You don't sell when price is nowhere, in the middle of nowhere. It's completely wrong. Okay, you buy the dip in uptrend, you sell into rally in downtrend. This is where you sell because the price is in downtrend. You can also use CCI indicator that I use in my live training webinar. And you need to look for thrust pullback formation. That is a sign of trend. So this is very, very important. Remember that, stick it to your screens, glue it, and always remind that you buy the dip, you sell the rally in downtrend, buy the dip in uptrend, and you can use price action or CCI. CCI is very good to show a trend. For example, here, this is a good example. Although I don't trade pound dollar now, it's, you know, it's price is going up and down, but this is just an example here. You see what happened here. Very easy to spot. Price is in uptrend, right? This is series of ups, downs, up, downs, but the angle is to the upside, thrust and pullback. And why did the price reject here? Because this is where historical buyers are, and here is the support. L4 Camarilla is support. Okay, this is support. This is CCI, color CCI. You see, and this is when price was oversold. So you have a confluence. Oversold price, double bottom, price is in uptrend, L4 support. If you add Fibonacci here, you will get your confluence zone. And this is where you buy. So you see, you can use CCI. It will tell you that the price is oversold. This is the text. We need to look for thrust pullback formation. So this is very important for you to understand. We have in an example in gold. Angel is saying, yes, this is a good example. Price is in uptrend. There is a trend line. There is Fibonacci. 61.8 again. Buying, historically buying from this spot. This is order block here. Bullish order block. Price is oversold. And not a coincidence that the price goes up. So this is where you buy. Not here, but rather here. It's always good to buy at support. This is L5 support. The strongest daily support according to Camarilla. So I hope that you understand these principles. They are very important for you to understand if you want to be a price action trader and to have a better understanding in price movement overall. I don't see any questions. So today, guys, is UK snap election. There will be a big volatility. Expect a huge volatility after 10, 11, midnight, 2 a.m., 3 a.m., 4, 5 a.m. There will be a huge volatility in the market. Tomorrow, we will cover the event and tell you which setups you can trade also. Any tips, place, you can watch for tips in my traders blog. But definitely, if we see a hung parliament, I think pound will drop. That is my opinion. Thanks as always. Use lower risk. Yes, I reply to most of you who ask for my template, so check it. Thanks, guys. Thanks a lot. Talk to you soon. Cheers and trade safe.